Hello, welcome to Global Weltrade Synthetic Signal Provider channel. Okay, if this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the bell notification so you get notified each time I upload a new content, and try to like comment and then refer the channel to your network so that YouTube will push us to a very high level of audience. Okay, in today's video, the topic we shall be treating is no retracement stacking trading strategy. No retracement stacking trading strategy. Okay, before I go to practical part, we are gonna discuss the theoretical part of this so that it will be more understandable. All right, here I'll start with an illustration of what stacking is. Okay, so this is the price as is, and this is the time as is. T, the price as is P, and this is the origin. Okay, now when market moves in a given direction, it actually split into two components: the impulse component and the correction or retracement component. So if a market is going uptrend, it first of all make some little pullback and then go up. Okay, then pull back, go up, and then pull back, go up, and then it can range at certain points. There are regions in the price movement where the market ranges. It normally range at the near the turning point, so it can range at this session, and then break off, or it can range in between, like along the impulse. But market can range whether along the impulse or along the retracement. It can range at any session, but you have to take note of that. Okay, now the general rule of thumb is this: always know the boundary of price movement. Make sure you bound the price movement by two parallel lines. Then when you have done this, wait for the retracement to complete, wait for the pullback to saturate, and then you see this impulse which is directed like this. It is not actually a straight line. Okay, this impulse actually look like this, is actually doing like this. Okay, so the general rule of thumb is, since this is uptrend and we are going to be buying, we are going to wait for the retracement, the major retracement to complete, which are the ones pointing that are generally pointing in this direction. You wait for them to saturate, and then you follow the impulse, which is this one. Okay, now when you follow this impulse, when market start impulsing, then you select support level where you are going to be loading position. So this is the first support. You load as much position as you want, and then you wait for the market to move. You wait for the market to like what I call go to action. You wait for the market cycle, and then when the market cycle completes, the market will create another strong support level for a new minor impulse, because this wave movement has minor impulse that will add up to give you the major impulses, right? So you add more position, then you allow the market action to complete its cycle, and then the market will create another support. You will add more position. This is actually based on belief. Anything can happen. The impulse can change direction, but this is based on belief, meaning that there is need for you to put more equity in case the market go beyond, like go against the support for a bit and then shoot, because such thing can happen, and that is liquidity sweep. Okay, and so you see, this is what you need to understand. So I'm going to the chart to explain this. The opposite actually happening in a downtrend market, or where you are looking for sell near strong resistances. Okay, this thing actually must happen in the time frame of your entries. Okay, which are preferably 4 hours down to the 30 minutes time frame. Okay, that's good. Okay, we are going to work on this asset. This is FSVO 20 index, and right here we need to run. First of all, you must know the trend. So I want to get the trend by top-down analysis. I don't need to actually look on all the time frame, but if you have time, you can do that for accuracy. But right here, in fact, top-down analysis is very important, right? But I can't do it here because of time. I will just be on daily time frame. Now, when I look on the daily time frame, I discover that each time price tend to approach this session, like each time price tend to approach this session, it experience sell, right? That's good. Now, that is a probability sell. There is a probability for sell, right? Now, what I will do is I'm going to do this based on what's actually happened in the recent time. I will consider here as order flow, which is true, because there was a base, like the sellers lost volume there. I'm sorry, the buyers lost volume there, and so the volume increased in the sell direction. So there is high volume spreads to favor sellers, right? So each time price come towards this order flow, which is also order flow is like a group of order block. So each time price come there is going to repeat the historical action, which is the sell. So with this belief, then what's the next thing? What is the destination? What is the destination of that sell? Where will it end? You discover that there was a base here, so the sell is likely going to end here. Okay, also you have to do it based on current paths. So here there are two close order flows here, so the sell is likely going to end here. So based on stacking theory, you have to confirm that this market have actually completed its cycle in order to reach here. So you don't want a situation where the market will create a counter cycle that will work against your entries. An example of counter cycle is this thing that happened here. So you're supposed to know that when the price is moving along this path, it will not just change direction, it will have to range to lose energy in the buyer direction before the sell volume, before the sell energy will increase. So as it go here, and then it must react to some other block or other flow and go up again, which it have done. It means that the buy action is almost getting completed, and then you see that there is a rejection here in the daily. The next day you have to expect that the sell will start proper. Yes, because we have double tops here. If you go to lower time frame, you will see a lot of double tops, and then we'll have fake breakouts. So you're supposed to know what is happening here. So the volume have risen now for sellers. Now what are you going to do? You go to your entry time frame. Right now I'm going to shade this like this because I'm going to stack along this path. You go to your entry time frame. I'll be on the 30 minutes time frame. Now I'm gonna rotate the screen. Right now I'll go there, and then this is what you want to do. First of all, you locate your first resistance, which is R1. So this is our R1. Okay, after, because basically we want this market to change direction proper, so we allow it to change direction, break against any barrier like support. Yes, support, there are support there. It actually break right, and then pull back, create a very strong resistance. Okay, you enter. This is your R1. So your R1 will come with your sell one, S1, which is your sell position 1. It can be as many positions as you want depending on your equity and your lot sizes. And so you see the market sold. Just feel free, allow. This thing is a kind of long-term trade. You have to hold the trade for a long time. So look at what happened. Look at what happened there. The market actually hit that resistance, sold very well, and go back to the resistance. You don't need to fear. You believe that this thing you are doing, you know what you are doing, you are stacking. So you are not afraid of retracement. There is retracement is something you have to treat as invisible action. Okay, so you see it's come back. You don't need to add position here, no, because you have already calculated your drawdown. So if you add it here, it doesn't make sense. You need a resistance too. You need second resistance, right? So this market came here, break this support. Remember, when the support is broken, it becomes a resistance, and the market pull back. What do? You add, as you convert the profits here, because it's no longer going up. At least, but before you do this, make sure there is change of action, change of character, which you see here. The market actually break out and change. So you don't want story for, you don't need anything that has to do with the breakout, this thing. You don't want drawdowns, okay? So you need a confirmed action that is ready to operate, okay? Right here, you start piling your position here as much as you can, convert all the profit and the equity, then you add position here. And what happened? The market push down, and then create and break. You see, break here, then it creates a resistance here. It came there, come down, come again, come down. So it failed to break it up, so it becomes a strong resistance. So you start, once it change direction, you start piling position, right? You start piling position. By the time, because this involves a lot of investment, by the time you get to your final destination, you should have seen exponential growth in your profit, okay? You see, this is advanced flipping, and it's very cool, okay? But there are different type of stacking, okay? But this one I have explained is the like a managed low risk stacking method. We have high risk stacking method, whereby once the impulse parts have started, you are going to be adding position each time the polarity of the candle, each time the previous candle aligns with the polarity of your direction. So as you are selling, each time a bearish candle open along the sell path, along the impulse path, which is along this path, you open a position, okay? But in this case, if there is unwanted drawdown, you have to add more equity. So it's very risky, but I don't want to go deep inside it. Make sure you are proactive, make sure you subscribe to our VIP, because most of the signals we learn in the VIP actually depends on this kind of stuff. And make sure you actually enroll for our courses if need be, and our mentorship if you are beginner or you don't know what you are doing as a trader. Bye for now.